Yeah, I think it's to do with the LBMA and COMEX. And I first touched upon that on January 29th. I always remember that date now because the FT came out and said that the Bank of England vaults were basically not in good not in a good situation because it was taking them 4 to 8 weeks to deliver spot gold, which is unheard of. And I haven't heard since if that's improved or if it's even gotten worse. And silver, I think, is the same. We're seeing a lot of shorting of PSLV shares. It's gone through the roof. So yeah, there's definitely someone out there, wholesale or sovereign in the West, maybe the United States government, that wants delivery of physical gold, and it hasn't really permeated into the retail sector where stackers buy their gold and silver. So it might not sound like there's anything going on, but I think it's really important, and it will permeate into the retail market sooner or later, in my opinion. Yeah, I don't think it's a U.S. government or a government. The thing with the PSLV, I think there's probably been quite a lot of demand from retail, and every time someone buys a share, they have to buy the corresponding amount of physical and leave it. I guess they leave it at the Canadian Royal Mint, wherever they store it. And Jesse, that there's been a lot of deficits, annual deficits in the silver market, i.e. production is a lot less than demand. And with what's going on in gold as well, I think we've seen that there's been a lot of physical delivery in the U.S. There's a lot of silver also flowing back to the U.S. So I think what the bullion banks, I think it's the bullion banks, I don't have any proof, but I wouldn't see any reason why for it to be any other institution. What they're doing is they're borrowing SLV shares, PSLV, excuse me. And that's another thing. If you don't want your PSLV shares to be lent out, you can leave a GTC order to sell your shares. Leave it at a really high price of $1,000, so it, you feel comfortable that you're not going to sell your silver, and that apparently makes it so that they can't lend your shares if you're working an order, or contact them and tell them to not lend your shares. But the reason why I think they're doing this is because, let's say one day the public were to buy 1,000 tons of silver through PSLV. Well, then the PSLV trust would have to go into the physical market, because they actually hold allocated and 1-for-1 silver that their investors buy. They'd have to go and buy that physical silver. So what happens when the bullion banks or whoever it is short the shares? Well, that nets out. if they sell 1,000 tons of worth of shares, the 1,000 tons of shares that have been bought, it nets out at zero. So the trust won't have to go out there into the market and get real physical. And that's very suspicious, in my opinion, because as you know, there's a silver deficit. There's a technical default on gold at the LBMA. We're seeing the silver, how can I say, the deliverable or the floating free silver at the LBMA, that's going down massively as well. I spoke to Eric Young, aka King Kong, the other day, and he said if you get three days in a row where a small part of the people who participate in the LBMA allocated silver market, if physical delivery, all that silver is going to be gone. So yeah, I think there's a lot of concern, and that's why if you look at the chart of PSLV shorts, it's going like that, like a hockey stick. Yeah, I think back in end of January, beginning of February, it was said that it was 400 tons that went from the Bank of England, and then we to the U.S. physical. And then we also have been hearing from StoneX, who's a LBMA member and a pretty big bullion dealer, that it's more like 2,000 metric tons that have flowed into the United States. And the other thing is that it's not just, it seems to be flowing outside the COMEX mechanism as well. So not just through COMEX. The implications to me is that it could unravel the whole LBMA, basically fractional reserve scheme for gold, or virtual gold trading, whatever you want to call it, paper gold. And that's the thing, Jesse, the bullion banks and the bankers in general don't see anything wrong with that, because that's how they operate the current fiat currency system. The Federal Reserve, back in 2020, under Jay Powell's leadership, they removed all the reserve requirements for banks. So if you put a dollar with a bank, now they don't have to keep any in reserve. It used to be that I think they used to keep more than 10 or like 12%. Now it's nothing. And I guess it was justified maybe because of what happened in 2020, 21. But now we're in 2025 and they still have that. So that's what they do with gold. And they do it because they've been able to do it because most people, usually the funds and the speculators, they trade gold on the LBMA, on the OTC market in London. It's just like a foreign exchange. It's like a currency. It trades. London is the biggest foreign exchange market in the world. The problem is that now someone big, someone that is kind of in bed with the regulators, it could be the government, is demanding delivery, and that kind of throws a spanner in the works of this fractional reserve paper leasing mechanism that in the LBMA is limitless. At least in New York, there's a limit, I think, to hypothecating gold. But in London, it's you can do it 100, 200, 300 times. And the LBMA, contrary to popular belief, the whole operation there, because of the Big Bang deregulatory or Big Bang rules in 1986-87 under the Thatcher government, basically gave control of the gold market to the Bank of England, and the Bank of England said the bullion banks can do whatever they want. We're going to turn a blind eye, and that's the way it's run. It's self-regulated, and I guess Jesse, this might be things coming back to haunt them, because they thought they could run a gold market based on basic mythical values, as I think President Putin called the Western financial system a few years ago, all based on money created out of thin air. So LBMA, it's gold created out of thin air, and silver as well, of course. President Reagan also changed the rules and regulations pertaining to American pension or insurance companies, and that they could invest more in the stock market. And look at what happened in the stock market. It bottomed around 1982, I think, and we've been in a bull market since then. massive bull market. So I think it's that kind of event. It could be for China, for gold and China, and I think it's not surprising because the Chinese government, they've been encouraging the public to own gold. So now I think it's natural that they're telling the insurance companies, yes, you can invest some of your assets in gold. I think it's 1%, but it's 1% that could make a huge difference because, for example, in the US, I think less than 1% of investable assets are in the gold and silver sector. So for a country as big as China, I think it's just going to continue to underpin the value of gold, or if you want to call it the price of gold, going forward.